I realize I just threw a new term at you, bad debt. My apologies. In simple terms, when you extend credit to customers in your business, there is a chance they might not pay that money back. That possible loss of money is what we call bad debt. It's just a risk that you take. From a bookkeeping standpoint, there are two ways to write off bad debt: the direct write-off method and the allowance method. The direct write-off method is the most straightforward and is used mostly by small businesses. However, there are some issues with it. The more accurate and appropriate method is the allowance method. This one takes a little more thought, but is better in the long run. I know this is a lot to take in, so let's hear from an expert with some advice about working with bad debt.
So occasionally when you're looking at a financial statement with your client, you might find accounts receivable is really not ticking down very fast, and you look through the actual open invoices with them, and you would go through that and actually ask them, is this collectible? Are you really going to be able to get this from Bob, who's owed you this for 5 years? So in some cases, the client may want to write this off as bad debt. It may not necessarily be the bookkeeper's decision to write things off as bad debt, but you should know about it, because when it does come up or you do detect that there are some uncollectible receivables there, that it's time to write them off. And so you'll be probably given instruction or permission from the owner to go ahead and do that. One thing you should consider is if it is a invoice from 5 years ago, you really don't want to go in and void the invoice, because what you would be doing is actually changing transactions from a prior period. So what you need to do is record bad debt. There's several ways to do it in accounting programs like QuickBooks Online, but for general purposes, we need to reduce income and then write it off in accounts receivable, so it doesn't show that that invoice is open any longer. So you could do a credit memo in QuickBooks Online and pull the item that was sold 5 years ago and reverse that. The credit memo could be applied to an open invoice and wipe that out. And you could also do a journal entry, which also represents that same thing. So we're going to debit income and credit accounts receivable and apply that payment against the open invoice to wipe it out. Again, bad debt is just something you need to be looking at when there are uncollectible items sitting there on the balance sheet, and it's just time to clean up the books. So periodically when I'm working with a client and we are reviewing their financial statements, I definitely open a report in QuickBooks Online that is the unpaid invoices report. And we go through that and look at it. And in some cases, this is usually with a new client because stuff just gets ignored and they're the client that's reached out that needs help. And so I'll look through things like that, unpaid invoices. And if I see things that are a year or two old or even older, I will have that conversation and say, what is all this? Did you actually collect it? It could be they did and they just didn't apply the payment properly. Or maybe it's just an older client that never paid their old bill, and that would be considered bad debt. So in that case, I would have the conversation pretty much invoice by invoice, customer by customer, go through their report, and then in some cases, I'll just email them the report or put it on Excel and have them fill in exactly what they want me to do with each line item, and then I'll go ahead and adjust it. Some might be bad debt, and some might be, hey, I got paid, but I don't know why this is still open. So I can fix it for them. So you just have to have the conversation with the client and review their existing records.